Think of your credit score as your financial report card. It's a simple three-digit number that tells lenders, landlords, and even insurance companies just how responsible you are with borrowed money. And when you have a higher score, you become a much more attractive borrower. That can be your ticket to qualifying for better loans and credit cards, all with lower interest rates that can save you thousands of dollars over time. So what is a credit score really, and why does it matter so much? At its core, your credit score represents your creditworthiness, which is a fancy way of saying the likelihood that you'll pay back money you borrow. Banks look at it when you apply for a loan, landlords check it to see if you'll pay rent on time, and some insurers even use it to help set your premiums. A good score opens doors to financial opportunities, while a poor one can create frustrating hurdles. Now, how is this magic number actually calculated? Credit scores are determined by a formula that analyzes all the information in your credit report. While there are a few different scoring models out there, the most widely used ones are the FICO score and the Vantage score. Most of them operate on a scale from 300 to 850. Your score is built on 5 key factors. The most important, by far, is your payment history, which makes up about 35% of your score. This simply shows whether you've paid your past credit accounts on time. Next, accounting for roughly 30% is the amount you owe. This considers your total debt and a critical metric called your credit utilization ratio, which compares how much credit you're using to how much you have available. For instance, if you have a total balance of $2,000 across your cards and a total credit limit of $10,000, your utilization is 20%. Experts generally recommend keeping this number below 30%. The length of your credit history makes up about 15%, with a longer history generally working in your favor. The final two pieces are your credit mix, which is the variety of accounts you have like credit cards, auto loans, or a mortgage, and new credit, which looks at how many new accounts you've opened recently. Together, these last two factors make up the final 20% of your score. So, what does a good score actually look like? Scores are grouped into ranges. If your score falls between 300 and 579, that's considered poor. The fair range is 580 to 669. Good is 670 to 739. Very good is 740 to 799. And exceptional is 800 and above. Once you hit that good range or higher, you can typically expect to qualify for the best terms and lowest interest rates. Of course, the big question is, how do you actually improve and maintain your score? Building good credit is a marathon, not a sprint, but there are some tried-and-true strategies. First and foremost, pay your bills on time every single time. This one habit has the biggest impact, so setting up automatic payments or calendar reminders can be a lifesaver. You'll also want to keep your credit card balances low, ideally using no more than 30% of your available credit at any given moment. And try to limit new credit applications. Each time you apply, it triggers a hard inquiry, which can temporarily ding your score. It's also wise to think twice before closing your oldest credit card accounts, since a longer credit history is beneficial, and closing an account can actually increase your overall utilization ratio. Habit to review your credit reports regularly. You can get a free report every week from each of the 3 major bureaus at annualcreditreport.com. Look for any errors, like accounts that aren't yours or incorrect late payments, and if you find a mistake, dispute it. Correcting those errors can give your score a quick boost. And what if you're just starting out with no credit history at all? Don't worry, you have to start somewhere. One common method is to become an authorized user on a family member's credit card, where their positive history can help you build credit. You could also apply for a secured credit card, which requires a cash deposit that serves as your credit limit and is designed specifically for beginners. Even a store credit card can be a good first step, as they often have lower limits and are sometimes easier to get approved for. So we've covered the fundamentals of credit scores, but if you really want to master your financial health, it helps to go even deeper. There are always nuances and advanced strategies that can make a big difference. First, let's talk about the 2 main scoring models, FICO and Vantage Score. While they both use the familiar 300 to 850 range, they have some key differences. For instance, they treat credit inquiries differently. With FICO, if you're shopping for a mortgage or an auto loan, multiple inquiries within a 14 to 45-day window are typically lumped together and counted as just one. This is their way of encouraging rate shopping without punishing you. VantageScore does something similar, but they tend to use a 14-day window for all types of loans. They also differ in how they view zero balances. If you don't use your credit cards at all, FICO sees that as being less active with credit. You won't have a bad score, but you might not score quite as high as someone who uses a small amount and pays it off, because FICO wants to see that you can actively manage credit. VantageScore is a little more forgiving of inactivity, though for both models, active, positive use is still the best strategy. And finally, think about the meaning behind the number. FICO is primarily looking at risk, specifically the likelihood you'll default in the next 24 months. VantageScore also looks at risk, but they put more emphasis on trended data, meaning they want to see where your balances have been heading. Are you paying down debt or steadily accumulating it? Now, let's bust a common myth. You may have heard that checking your own credit score hurts it. That is completely false. There's a big difference between a hard inquiry and a soft inquiry. A hard inquiry happens when a lender checks your credit because you've applied for a loan or card, and you have to authorize that. It can temporarily lower your score by a few points. But a soft inquiry, which is what happens when you check your own score or when a company checks you for a pre-approval offer, does not affect your score at all. In fact, checking your own score is a healthy habit, and you can do it for free through many credit card apps or websites. You've probably heard the advice to keep your credit utilization under 30%. That's solid, but if you really want to optimize for the highest possible score, especially before a big loan application, there's a strategy called AZEO, which stands for all zero except one. The idea is to let all your credit cards report a zero balance to the credit bureaus, except for one single card. On that one card, you let a tiny balance, maybe just $5 to $25, get reported. This shows the scoring models that you do use credit, because you have one card with activity, but you also have an incredibly low debt load. It maximizes your points in the amounts owed category. The caveat is that you only really need to do this in the 30 to 45 days before applying for a major loan like a mortgage. For everyday life, simply paying your statement balance in full is more than enough. What about closing a credit card? It's a decision that has two very different effects on your score. On the positive side, the length of your credit history is safe. A closed account will remain on your credit report for up to 10 years and will continue to age, still benefiting your average account age. The immediate danger, however, is to your credit utilization. When you close a card, you lose that card's credit limit. So if you carry balances on other cards, your total utilization will spike because your total available credit has just shrunk. For example, if you have two cards, one with a $5,000 limit and a zero balance, and another with a $5,000 limit and a $2,000 balance, your utilization is a healthy 20%. But if you close that first card with the zero balance, your utilization suddenly jumps to 40% on the remaining card. Understanding the timeline of negative marks can also help you grasp the urgency if you miss payments. At 30 days late, the creditor reports the late payment to the bureaus, and that's the first major hit to your score. If it reaches 60, 90, or 120 days late, the account becomes progressively more delinquent, and the lender may eventually charge off the debt, writing it off as a loss, though you'll still owe it. If the account is charged off, the original lender might sell the debt to a collection agency, which then adds a separate collections entry to your report, which is a major red flag. In more severe cases, failing to pay certain debts, like taxes, can lead to public records like tax liens or judgments, which are very damaging. And bankruptcy is the most severe of all, and it can stay on your report for up to 10 years. If you do end up with a collection account on your report, there's a negotiation tactic you should know about called pay for delete. Normally, if you pay a collection debt, the agency updates the status to paid or settled, but the negative mark itself often stays on your report for 7 years. A pay-for-delete agreement is different. It's where you offer to pay the debt in exchange for the collection agency deleting the entire account from your credit report. Not all agencies will agree to this, and the credit bureaus technically discourage it, but it is a common practice, and it's always worth asking when you're settling a debt. Finally, let's revisit the idea of being added as an authorized user. It's a fantastic way to build credit, but it's a trap if you're not careful. The risk is that it works both ways. If the primary cardholder misses a payment or maxes out the card, that negative history can also appear on your credit report for that account. So, you absolutely want to ensure the person adding you has impeccable credit habits. Be wary of any service that offers to add you to a stranger's card for a fee, as that's often a piggybacking scheme that the credit bureaus may eventually crack down on. So with all that in mind, what area are you most curious about? Are you looking to start building credit from absolute zero, or are you searching for specific repair strategies? Ultimately, understanding your credit score is one of the most powerful steps you can take toward financial freedom. Hopefully, this gives you a clear picture of how it all works.